What's up, everyone? It's Karthik with Moneyvest. So markets with a very modest gain on the day here, pushing higher just over 25, 30, 40 basis points. We were kind of back and forth here on the day after we had the jobs report. The revisions came out 32 minutes later. I was live to cover those numbers. At 10 a.m. Eastern, the markets moved a little bit. They were volatile right about here. And then, of course, after the numbers came out, we were pushing higher, then back down. And then, of course, the FOMC numbers, FOMC minutes came out at 2 p.m. Eastern. But all in all, we closed fairly green with the NASDAQ pushing up over 0.5%, the S&P 500 up over 42 basis points, and the Dow Jones pushing up over 14 basis points on the day. So this is a restart of those streaks here, because yesterday, of course, the S&P 500 was indeed lower. So the Magnificent 7 index was also up over 0.5%, with, again, you can take a look at the Magnificent 7 indicators and the stocks here. So semiconductors all in all, which is SMH or SOXX, was up over 1.3%. So very nice move on the back of course, Nvidia pushing up almost 1%. We had Tesla up almost 1%, Meta also pushing up over 1.6%. So we got lots to unpack and discuss in this video, with over 4,000 stocks pushing higher on the day, with over 1,600 declining on the day. All I'm asking in return from all of you is that you drop a like. Let's see if we can at least get up to over 1,000 likes on this video. I would really appreciate that. And share this video with your family, friends, other traders, investors that can benefit from this content. We're trying to get to 82,000 subscribers, and I would really appreciate your help in getting the word out there. Recommendations like this really help us grow this channel, so I would really be grateful for that. And furthermore, I have created a brand new tier called Moneyvest Education. So if you've ever wanted to further your education around the markets, learn about fundamental analysis, technical analysis, options trading, and how to sell options, as well as psychology of investing money in markets, those are 4 courses that we have on Teachable, which I now have moved over to Patreon. So if you're interested, this right here is going to be the URL. I'll link it down below. But this is our Moneyvest page, and you can come down, explore some of the options. Of course, you've got the general community subscription, but then you also have the Moneyvest Education, where you can access over 4 courses, and that's 120 videos that are already available for all of you. So you can access all 4 courses, 120 videos with 30 hours of content. And if you scroll down further, this is going to be the course curriculum. Fundamental analysis, you can pretty much go over it yourself. There's over 42 videos included on the fundamental analysis. We got the technical analysis course also included, charts, patterns, candlesticks, trading strategies, everything's going to be included with, again, 43 videos here. Options course available. There's going to be over 20 videos on this, and then the psychology of investing money in markets and philosophy of life course, which also has over 21 videos. So all in all, 30 hours of content, over 120 videos. It's taken me over 3 years to create all this content, and it's going to be accessible to all of you under Moneyvest Education subscription, as well as the Discord access and the website availability as well. So all of that is going to be available with one simple subscription, everything bundled up in one simple plan. So link's going to be down below. So first things first, let's talk a little bit about the panic lows from Monday, August 5th, and how these stocks have performed since those levels. Nvidia is up the most, a little bit over 43%. Good thing we bought Nvidia back on Monday, August 5th. I actually did pick up Microsoft and Google as well. I picked up VUG. I also picked up SMH, which includes your semiconductor stocks. And those were the main ones. Those are the primary ones that, of course, I ended up buying. And then pretty much a combination of all of these, because I did end up picking up FNGU as well, which is a leveraged trade, which I then ended up closing out for a nice reasonable profit. But if you take a look at every single one of them, most of them are up double digits here, anywhere from 10 to as much as over 22%, with Nvidia with a massive 43% recovery from those lows as volatility did spike. Now, switching gears, we did have, of course, the US jobs revisions, which was the largest revision since 2009. So in over 15 years, we had the biggest revision to the downside for these jobs over the last 1 year. So what we really witnessed was the 818,000 jobs was that number. So this was the report that I broke down in my live stream. And again, we discussed that in our yesterday's market update as well. So 818,000 was that number. In other words, that's how many jobs disappeared from the economy in the last 1 year, because that's how much was the overstatement from the Bureau of Labor Statistics. Now, in the past, what CNBC basically did is that they essentially put down some few facts to consider. So there's a lot of debate of how much of a signal to take from the 818,000 downward revisions in the US, the largest since 2009. And here are some of the facts that they've laid out. So by the time 2009 revisions came out, which was 824,000 jobs, which were overstated in the economy, the National Bureau of Economic Research, so NBER, they are the ones that actually announce whether we are in an official recession or not, had already declared a recession 6 months earlier. Jobless claims, a huge data source, which by the way comes out tomorrow, had surged north of 650,000. Right now we're somewhere around 250,000, so we're still significantly lower. But back then in 2009, we were at over 650,000, and the insured unemployment rate had peaked to over 5%. Which was that very month. And GDP, which is the gross domestic product, reported at the time had already been negative for 4 straight quarters. And it would subsequently be revised higher in the 2 of those quarters, one of which was revised higher to show growth rather than a contraction. So we had 824,000 jobs overstated back in 2009, something very similar to what we just witnessed today. And back in 2009, 6 months prior to that, the NBER had already announced or declared a recession, 650,000 unemployment benefits or initial claims, and we had 4 consecutive quarters of GDP declines. And if you compare that to where we are right now, there's not been any recession that's been declared. The 4-week moving average of jobless claims sits at 235,000. The insured unemployment rate sits at 1.2%, which again is significantly lower, and the reported GDP has been positive for 8 quarters in a row. Now, one of the things that is not highlighted in some of these numbers is the shift in the overall consumer environment over the last 15 years. The fiscal deficit, the level of debt, credit card spending, mortgages, auto loans has significantly skyrocketed in 2024 as opposed to where we were back in 2009. So what may seem like a very, very strong, healthy, functioning economy where people are spending money, earnings are good, jobs are, plentiful, may not in reality may not be the case. Why? Because again, we know that credit cards are topping up to over $1 trillion. Mortgage debt, auto loans, delinquencies are on the rise. Corporate bankruptcies are at their highest level since 2017 as more and more companies are filing for Chapter 13, Chapter 11, and Chapter 7 bankruptcies. Even households are actually filing for bankruptcies as well at the highest level since 2019. So there's a lot of indicators that are suggesting for the reality, which is not as good as what we're being told, right? So yes, on the surface, it seems like everything is working out, everything is going well, and that's really what the markets care about. At the end of the day, like as long as earnings are good, that's what the markets really truly care about. If earnings are good from these companies, the 500 companies that are part of the S&P 500, of course, in general, the entire market, the markets are going to see that as a very strong signal for consumer strength and retail spending and just spending in general. Doesn't matter where that's coming from. Doesn't matter whether that's credit card debt or personal loans or whatever the case might be. As long as people are spending money, swiping those cards, earnings are strong, pricing power is strong. The markets continue to plow forward, unhinged of what could possibly be on the horizon. So really what I want to take away from this report is that this is a pretty significant revision. The economy, of course, has changed significantly from what we witnessed back in 2009, and I'm going to be prepared. So right now I'm sitting on about 15% cash. So my cash percentage right now is sitting at 15%. I just calculated that today, and this number will most likely now increase to 20%. So what I'm going to do over the next couple weeks, and in fact, even the next few months actually, especially when we kind of head into September and into October and pre-election. So really my game plan for the next 2 months is to raise more cash. So whatever I picked up, so I deployed close to $50,000 in the last 2 weeks, which I'm very happy about. So I'm going to continue to hold those positions, of course, for the long term, because my idea was to dollar cost average into some very high quality stocks here in the first place back on Monday, August 5th. And of course, have a few trades like selling calls and also at the same time have some cash secured puts and FNGU trade. All that is well and good. But moving forward, I'm going to try to increase my cash exposure from 15% to well over 20 to 25%, as I've already broken down my liquidity framework, which goes over what percentage of cash and how many months worth of expenses I think one investor should have in their bank account and their brokerage account. So definitely do check out the video if you haven't already, because I think there's a lot of value there. So my goal would be to sell calls moving forward, as markets continue to move higher, I will be looking at selling out of the money calls, whether it is a buy right on Nvidia. I've been thinking about doing a buy right on Nvidia, which is buying 500 shares of Nvidia and then immediately selling calls up to 140. I think for the 1 week, it was actually quite crazy. 1 week, the premiums were up to $2,500. So that's what I was thinking. I'm going to be planning a trade most likely towards the end of this week, because next week also Nvidia is reporting earnings. So that is something that I have to keep in mind, because volatility will be extremely high. And if Nvidia, for whatever reasons, growth rate starts to slow down or misses expectations, there's a possibility for an 8 to 10% drop in Nvidia. So that's something that I have to really account for from a risk analysis standpoint. But again, I will update everybody on Discord. So the idea here is to raise more cash, go from 15 to as much as 20, at best 25% by selling calls, and of course putting more money into the brokerage account with savings, with investing, with income, and then be prepared. Be really prepared, because look, I don't know if there is going to be a recession or not. I don't know if the jobs revision to the downside, such a significant number, is going to mean anything. It sure would mean something from an unemployed person's standpoint. We know for a fact that it's most likely going to increase that unemployment rate just a little bit. And even if you do dip into, let's say, a mild recession, right, the shortest recession or a very, very mild recession, I think it never hurts to be prepared, to be ready to dollar cost average for when there is opportunities again. If there is another instance where the volatility spikes again, I think it's really important for us to be ready, be prepared. And I'm going to go over the volatility here in just a second in our dashboard. But this right here, again, 818,000 jobs is a pretty significant number. Largest inversion of the yield curve. For me personally, it just does not hurt to be ready and prepared for if there is a recession. I'm still invested. I'll still be invested 75 to 80%, and I'm not selling stock by any means, but I'm just starting to raise more capital, raise more cash here as I kind of buff up my drying powder and my buying power moving forward over the next couple of months, especially when we hit that September seasonality in just about a few weeks. So that is going to be the plan. And a few more indicators that are kind of alarming is going to be the dollar index. As you'll notice that it continues to slide lower. This is something that we discussed in our previous video. This right here was a little bit of a higher low for the dollar index, which we discussed, and then we broke down below this level, and now we're coming back to the lowest level since the beginning of 2024 at just about 100, right? 100.86. That's where we are sitting at the moment. So this is a little bit of a broader trend. You'll notice that we are coming back down to the lowest level since 2024, and at the same time, gold continues to move higher. So I actually did a video on gold recently, talking about how this is an asset class worth diversifying into. It's a great store of value. A few people seem to disagree with that analysis in the comments of my previous video, but I disagree, because I think gold has stood the test of time for over 4,500 years. So many centuries it's been around, and it's now hitting a new all-time high of well over $2,500 per ounce. It's up almost 40% since September of 2023. I started buying it just about a couple of years ago, and it has done incredibly well, hitting a new all-time high, and in my opinion, starting a brand new cycle of this uptrend of higher highs and higher lows. And again, this is an asset class that actually tends to perform better during times of distress, during times of crises, during times of uncertainty, because at the end of the day, yes, it's not an income producing asset, but it is still an asset. It's a commodity that is very, very liquid. You can literally take gold, sell it anywhere you want. Most stores, most reputable jewelry stores are going to buy gold from you. And then, of course, it's an appreciating asset because it has been doing that. And for those reasons, I don't mind diversifying a little bit of my net worth, a little bit of my portfolio into gold. And I've been very much a proponent of this overall thesis for well over 2 years. And I think it's still got a lot of momentum left in the tank over the next 5, 10, 20 years, right? So over the longer term. Now, coming over to this was from Charlie Beeler, kind of once again re-emphasizing on the idea the dollar index continues to slide lower. Lowest level since actually December of 2023, so lowest level in 2024. And the gold ETF hits a new all-time high, 22% higher year to date. So once again, I think it's really important for us to be careful that if the yields continue to come down, which in my opinion they will, considering how aggressive the Federal Reserve will most likely be now with the rate cuts, which I'll also break down the FOMC minutes in just a minute, that's going to push the yields down, that's going to push the spreads down, and that's thereby going to push the dollar index down against the Japanese yen, thereby putting more pressure on equities, and some of the more safe haven stocks are going to be the ones that may come out on top such as gold. But again, from a quantitative easing standpoint, that is going to be a good positive catalyst for equities as well. So really don't want to be completely out of equities, but definitely want to diversify a little bit more into gold as well. So he also mentioned that U.S. national debt has moved from $22 trillion to $35 trillion over the past 5 years, a 59% increase, and it will go much higher in the years to come because there's absolutely no political will to stop deficit spending before it becomes a crisis. And again, this is something that I have mentioned time and time again. There's really only two risks that I see for the U.S. Number one is, well, actually, there's maybe three risks that I see for the United States. The number one is the spending, right? So deficit spending and then funding that deficit spending with the debt levels, which we are seeing, which are expected to cross over $50 trillion in the next, 10, 12 years. So that is number one, because nobody really knows how that story ends. Nobody knows. I mean, Ray Dalio has written extensively on this topic and talks about, the reset or the big reset or the world order changing and shifting of powers here. So again, that's a basically a problem that we'll encounter, in my opinion, in our lifetime. If you're in your 20s, 30s, 40s, it's possible that over the next 20 years, we kind of come across a challenging environment for the overall fiscal situation over in the US because of the rising debt. Number two is, again, the lack of innovation or complacency, but I don't see that happening in the US because the US is where there is a lot of innovation, there is a lot of technological advancement, and as long as the companies continue to be the top of the world, basically a lot of the Magnificent Seven companies are the powerhouses that power the entire world. They're able to generate higher levels of earnings, higher levels of pricing power, higher levels of innovation, higher levels of advancement, and as a result, earnings growth with price growth will continue to be there. Now, I think one of the biggest pitfalls for investing long-term is to believe that stocks only go up. I think that is one of the most dangerous things that one can think about when they're investing long-term, is that stocks only go up. Yes, the data suggests for the stocks to go up over a long period of time, but that has happened because earnings and earnings potential has continued to go up, right? There's been economic growth in the overall economy, right? The US has done really well to grow its economic ability to generate goods and services over the last 200 plus years. And as a result, we've seen that translate over to equity prices, asset prices, and that's why we've seen so much appreciation. But don't mistake that with the dangerous belief that that's going to continue forever. We just have to keep our eyes and ears open to make sure that we understand the landscape, the political and the economical landscape that we're in, and of course make decisions accordingly. Because the moment any economy stops growing, the moment we see economic weakness and it starts to decelerate, the moment earnings start to come down, again, I'm just talking in hypothetical terms here because it's never really happened for the US, especially not in the last 100 years. But if that were the case, then of course we'd be in a situation where we'll have to look elsewhere for returns. So just because what's happened in the past 100 years does not mean that it's going to happen forever. And the last and foremost reason, of course, is going to be some type of geopolitical tension, some type of war scenario where it's going to be a black swan event. I was actually watching a documentary on nuclear weapons, and it's actually quite crazy. There's I forgot what her name is, but she's written extensively on this topic, and she talks about if something were to break out, things will end in about 72 minutes. There's literally from start to finish, things will end in 72 minutes if something were to break out. And again, I don't want to go over to that scenario because that is actually quite scary, but those are the three biggest risks that I see long-term from a alpha standpoint, right? If we're looking to invest for the long term, those are the only three risks that I don't have the answers for right now. But everything else kind of falls within a purview of where we can be buyers, where we can continue to dollar cost average, and of course look for those returns over the long term, as there's going to be short-term weakness and short-term panic and fear in the market. Okay, coming back over to reality, Fed minutes point to likely a rate cut coming in September. So vast majority of participants in the July 30th, 31st meeting observed that if the data continued to come in about as expected, it would likely be appropriate to ease policy at the next meeting, which is something that we had already known. And the documents stated that several meeting participants observed that the recent progress on inflation and increases in the unemployment rate had provided a plausible case for reducing the target range by 25 basis points at this meeting, or that they could have supported such a decision But they also mentioned that several is a relatively small number of members that they're referring to. But I think it's pretty much a done deal that we're going to see 25 basis points in the September meeting. Now, this is where we are. We are now approaching the Moneyvest index at almost 4, which is, again, some of the very high unfavorable risk-reward territory. Almost 16 for the volatility reading. We're in the 41st percentile. 73% of stocks trading above their 50 SMA. 75% of stocks trading above their 200 SMA. We're in the 74 percentile and 70 percentile respectively. 0.862 for the put call ratio. Our side trading at over 62. We're in the 73rd percentile, and the volatility contango between M1 and M2 now sitting at a very healthy 14.22%, representing a very healthy, uptrending, and stable and bullish market trend at the moment. So this is where we are. The moment the VIX contango level starts to deteriorate and comes down to closer and closer to 0%, that's going to be one of the early signals to be more defensive and, again, continue to raise more cash. And that's going to be the plan here for myself over the next 2 weeks. I did some buying today, picked up more Palantir, picked up some Nvidia, picked up some VIM, picked up some other ETFs and stocks. But the overarching idea will be to continue to raise more cash here and getting up to 20 to as much as 25% cash exposure in preparation of what I believe September seasonality to be a pretty incredible month. So this right here is the overall market. So again, we were slightly higher. Crypto is getting a lot of inflows. We did have fixed income more or less flat. US small cap, US mid cap, large cap, everything pushing higher, with US sector overall pushing higher. So all 11 sectors, well, most of them were green, with communication services and energy slightly down in the last 1 week. We've got 10 out of 11 sectors green, with energy still struggling. And we have Bitcoin back over 61,000 and Ether just over 2,600 as well. And finally, one final chart that I want to address is going to be the forward S&P 500 total returns after the largest percentage decline over a 9 trading day period for volatility, which was put together by Charlie Bulow on X, and a 61% decline. And every single time that's happened, 48% or higher, we've seen markets higher 1 year, 2 year, 3 year, 4 year, and 5 year basis. They have been higher, and that's been an incredible return on average by anywhere from 14 to as much as almost 90% between those different time frames. So volatility, when it's high, it is time to buy. In my opinion, has been one of the best indicators for us here at Moneyvest on this channel. Okay, coming back over to this. So Moneyvest index, as we already discussed, was as high as 3.88. This number is going to now update it to 3.98 as it continues to move higher. So I guess it gets closer to 4. Volatility here down to 16.26. So a little bit of an increase, 2.5%. But again, keep a close eye at some of these levels at 18.8 to as much as 20. To as much as 23 to as much as 36. So that right there is where the goals are going to be. So the higher the VIX goes, again, the better the opportunities will be. Crude oil continues to break down, which is actually a good thing for overall inflation. So we're kind of trading at support at this green rectangle. And if we continue to see this further breakdown, $66 a barrel is going to be that next target and that next support level to watch for crude oil. Coming over to the markets now. So S&P 500 pushing up, seeing that continuation of that rally and getting closer and closer to all-time highs. So we are very close, folks. This right here is the overall market snapshot. You can see prices versus all-time highs. S&P just over 1% away from all-time highs, and the Dow Jones is just over 1.2%, and the NASDAQ is just a little bit over 4% away from its all-time highs. So we are now very, very close, inching closer and closer to victory, to all-time highs after having a very nice, reasonable correction. From those Monday lows, we are now up a little bit over 9.86, almost 10% higher from where we were just a couple weeks ago. And the next target and resistance stays put at 56.70, with a very strong support here inside this green rectangle for S&P 500, sitting roughly at 55.65. Talking about QQQs or the NASDAQ, again, very similar pattern as it continues to move higher and higher. Support level is going to stay put right over here at 476, 475, and the next resistance and target pretty much at 487. We're still a little bit away from all-time highs, specifically the NASDAQ 100. It's still over 4% away from all-time highs, so 487 is going to be that level of resistance next, to as much as that support here, 475, 476 for this particular ETF. Talking about Apple, and Apple here consolidating sideways, so it was more or less flat after, of course, having a very significant recovery from those lows. So from Monday, Apple stock is up over 15%, and the next target and resistance stays put at $236, $237 for Apple, and support level is going to stay put at $207 per share. So very, very nice move higher. It's kind of like in that middle range where there is more potential downside here considering the potential upside, but 236 is going to be that target and that resistance to watch for Apple. Coming over to Amazon, and Amazon here also up over 69 basis points. Support level is going to stay put down to 173 with a resistance all the way up to as much as 189, close to $190 for Amazon. So this right here is going to be that support level to keep in mind for this company. Tesla, I'll be doing a separate video on Tesla as well. Tesla, Palantir, SoFi, I'll be doing a more separate, more dedicated video on these three companies. But next resistance for Tesla is going to stay up at roughly at 233. So that is going to be that level to watch with a support level sitting roughly at $208 per share. So of course we came down, validated that support, got a little bit of bounce back higher from those Monday lows, but we're still very much within the context of a downtrend of lower highs and lower lows. So I want to be very clear that we are still well within this downtrend of lower highs and lower lows at the moment. Talking a little bit about Meta platforms, and Meta here also pushing up over 535. So Meta was a big winner on the day among Magnificent 7, up over 1.6%, coming up to its resistance of $540. So that right there is going to be that resistance to watch. And of course, if we do get a breakout, we're going to be hitting new all-time highs, and at the same time coming up to its resistance actually, and that's going to be the level sitting roughly at around 545 to as much as 578. I just want to confirm that that is indeed the all-time high. Yep, so that is going to be that area of supply and resistance to watch for Meta. Talking a little bit about Netflix, and Netflix here continues to move higher with a very nice consistent higher lows, and you could argue that we are also making some nice higher highs here for Netflix, so nice little uptrend as it gets bought up here from this higher low, and we're also now coming up to its resistance a little bit at $700. So this right here is going to be a resistance to watch for Netflix. As you can see that we've gotten rejected here back in July, and if you get rejected here against, there's a potential for a bit of a pullback considering how overbought we really are now with the RSI, the MACD, and the L3 banker oscillator. So if you do get rejected here, which the probability for is very high, a pullback is not unlikely with the support level now sitting roughly at 661 for Netflix. Coming over to Google, and Google here also pushing higher. Did pick up some Google actually today as well. I think I did. I think I sent out the alert for Google. But support level is going to stay put here inside this green rectangle as we already are. Resistance all the way up to 176, and we're seeing a little bit of that momentum on the other side, the MACD. Google is actually perhaps one of the only stocks that's performed the worst since Monday, a couple Mondays ago. So it's only up 8% as you can see over here compared to Microsoft's 9%. So those are the two stocks that are underperforming S&P 500 and of course their counterparts, as well as not even approaching up to a double-digit return since the August 5th Monday's closing price. Of course, Nvidia being the best performing stock. So I do believe that Google, there is that risk of the DOJ, but I do believe it's also a bit more overblown, and there is potential upside here for this stock. Resistance staying put at 176 for Google. Coming over to Microsoft, and Microsoft also continues to see that nice little recovery back up. Resistance at 432 with a very strong area of demand inside this green rectangle sitting roughly sub $400 for Microsoft as well. Coming over to Nvidia. And Nvidia, as you can see, that we're just consolidating sideways, up almost 1% on the day. Resistance all the way up to as much as $139. So this right here is going to be that level to watch for Nvidia with a very, very, very strong support sitting roughly at $96 per share. And like I said, I'll be planning on a buy right for Nvidia very soon, considering that it's trading at pretty much extended levels here, but there is going to be some high levels of risk involved because of the binary event that we've got coming on next week for Nvidia. So if I do end up taking that trade, it's going to be close to a $70,000-$80,000 trade if I do do a buy right on Nvidia stock. So that is, again, I will be updating everybody on Discord, and we'll see what the implied volatility is telling us for next week. What are the premiums? How much can I manage my risk on that trade. So again, if you want all that excitement, link's going to be down below. You can join us with that 16% annual discount that expires at the end of this month. And then finally, if you come over to Advanced Micro Devices, Costco, and Enphase, so this right here is going to be AMD. Very nice recovery back up. 157 is where it's at, up almost 1% on the day. And this right here was a, again, very overblown move, up a little bit over 30% from those levels, back up to that support that's going to be sitting roughly now at 149, 150. And a very strong resistance sitting all the way up to $185 for Advanced Micro Devices. And then finally, we come over to PayPal and Visa. PayPal here, after the breakout, saw a little bit of a pullback. Understandable, considering how overbought it was with the RSI, the MACD, and the L3 banker oscillator. So 60 basis points lower on the day. Support level is going to stay put roughly at $68 to $69 a share for PayPal. And the next target, next resistance, as we already know, sitting at $76 to $77 for PayPal. Visa still well within its downtrend, so lower highs and lower lows. So we're not out of the woods yet. And support level is going to stay put at 266, with a near-term resistance, of course, coming up to its lower high over here, all the way up to as much as $272 for Visa moving forward. And finally, we come over to Costco and Enphase. And Costco here, almost back up to its all-time highs, up 60 basis points. So this is a little bit of a defensive play, so to speak, but again, trades at a very expensive valuation, in my opinion, from its Monday's August 5th lows. The stock is now up over 11%. Also, resistance is going to stay put right over there, and that's a target of close to $894, just sub $900 per share for Costco. And finally, we cover Enphase. Enphase here pushing up over 1.9, almost 2% on the day. Very nice recovery from that area of support, sitting roughly at $96, $97. And the next target, well, there's I guess there's a little bit of a reasonable recent target of 120, and then of course a quadruple resistance or a triple resistance for Enphase, sitting roughly at 138 to as much as 141 for this company. So hope you all enjoyed this video and a complete update on the markets. Please make sure that you drop a like and subscribe to the channel. Share this video with other family, friends, traders, investors in your community, Discord, Telegram, WhatsApp, Facebook, whatever it is that you use. I would really appreciate that. It helps our channel grow very, very much. And links going to be down below if you want to join. Of course, get access to all the members-only private videos. There's about 120 videos that you can access with 30 hours of content, all the 4 courses, as well as engage with over 1,000 investors and traders globally. Access all website features and future updates, trade alerts, investing alerts, ideas, options alerts. Everything's going to be included, as well as our research and analysis and our website access as well. Link's going to be down below with a 16% annual discount that expires at the end of this month. Happy investing. I'll see you all in the next video.